Hello, in this presentation we will compare QuickBooks Online versus QuickBooks Desktop. Hello, in this presentation we will adjust our beginning account balances within QuickBooks Online. We will have a comprehensive QuickBooks Online course soon, if not available yet. We also have a comprehensive Excel course which complements the QuickBooks courses and a QuickBooks Pro desktop version course you can find at the link below. We will be continuing with the Get Great Guitars. If you've been continuing with us, that's great. If not, that's okay. We will be adjusting the beginning balances, something that needs to be done anytime we enter new opening balances into the QuickBooks program, because QuickBooks, while allowing us to do that without having journal entries, enter beginning balances into accounts, that is, it then needs to put the other side somewhere, and QuickBooks will basically just decide where to put that. And we might need to adjust that. There's going to be some accounts that we'll be able to see that will be obviously adjusting accounts, and we'll see what we can do with those accounts. First, let's see some reports so we can see what we are talking about. So we're going to go down to the reports here, and I'm going to choose a report that's a little bit more of an accounting report, which is the trial balance, but it shows all the accounts. It's kind of like a list of accounts, although it does have debits and credits included. So here we will go to the trial balance here. There it is. So we're taking the trial balance. That's what we're looking for. And we will run this report. Now remember, we're working as of 2021. That's going to be when we entered data, January 2021. And we entered all the beginning data for the day right before that. So what we're going to do is run the day right before the period in which we're going to start entering transactions, January 1st, 2021. So we want to look at 12/31/20. 12/31/20 and run that report. So we got 12/31/20. This is when we entered all of our beginning balances, because we expect to start entering data the first day of January 1st, 2021. So we have our beginning balances, and most of these, all we did here was to put a beginning balance in a checking account. And that's only one side of a transaction, so QuickBooks must have done something somewhere else. And same with the accounts receivable, we only did customer balances here to get this balance. We just entered customers and their balances, and QuickBooks must have done something else in order to make that balance. Inventory, all we did was enter items of inventory and the amounts we have, and QuickBooks put this number here, and that must have done something else. Furniture and fixture, we put in the beginning balance for furniture and fixture, and QuickBooks must have done something else. Accounts payable, we put in beginning balances for the vendors that we put into the system. QuickBooks must have done something else. Visa, we just put in a beginning balance, so that's only one side of a transaction. QuickBooks must have done something else. And then we have the loan payable, we put in a beginning balance. And then we're down to the equity section. And we see here we didn't do anything yet to equity. We didn't do anything to equity, yet we have this equity account, opening balance equity. That's clearly going to be part of the transaction that QuickBooks did in order to make this work. So we have that account. So this account's not typical. We don't really want that account. QuickBooks is just basically saying, hey, this is our opening balance. This is what we did in order to allow you to just put in these beginning balances and not have any adjusting journal entry in order to do that. And then we have sales, and we have other miscellaneous expenses, two other items, which once again, we didn't actually enter anything into sales or other miscellaneous expenses. The QuickBooks is putting this on the other side of the transaction for, it looks like, accounts payable and the accounts receivable when we created those. So when we put in other words, the customer balances for $20,500, QuickBooks said, let's just make invoices for that. And that's how we're going to put the other side together so that the debits equal the credits. When we put in the $15,000 to accounts payable with vendors that owe us money, QuickBooks said, maybe the other side is just going to be some type of expense. So that's kind of okay, because as long as these two amounts are temporary accounts, they're going to go away as of the first day of the year that we're actually going to be working on, which is January 1st, 2021. So we really want these two to go away. They'll roll into whatever our equity account is. These are temporary accounts. So let's just see what happens if, for example, we go to the first day of the next year. So I'm just going to hit +1. We're now on January 1st, 2021. Plus, and now we're on to January 1st, 2021. Let's run the report. And here we have our information now. Now we've got the opening balance here, and those two other accounts, the revenue and expenses, are closed out to just retained earnings. So that's where we want it in essence. Retained earnings is more of a corporate account rather than having an equity account for a sole proprietor, but it works in the same way in essence. So now we just have this one account which represents the book value of the company, and then we have this other account which QuickBooks just made up to make the debits equal the credits. So it's a permanent account. Notice it didn't go away. It's not an income statement account. It's a balance sheet account, in other words. And so what we want to do is just close this out to retained earnings. Really, this is part of retained earnings for us. Now, there's a couple different ways that we could do this. One is with a journal entry. That would be the typical way to do this. If we entered a journal entry, we would say that this is a credit, and we need to do the opposite thing to it to make it go down to zero. We would debit it by the $79,896, and then we would credit, making retained earnings go up by the $79,896. And that would be the journal entry we would do to get rid of basically the opening balance and put the amount into retained earnings. Because we're using QuickBooks, we could use the register functions as well, just to get used to the register functions. And note that QuickBooks is going to try to do a lot of the data input without needing journal entries. There's some places where we pretty much need to know the journal entries, even if we use the registers as we will do now. We still need to see that we have something in opening balance equity. But the registers are a way for us to try to reduce the amount of debits and credits. The more debits and credits we know, the more we can really better understand how the system's really being built. But it's good to try to work within the QuickBooks system and see the alternatives that they have to entering just journal entries. So in this case, we're going to try to use the register system. And the register system, for a check register, we're all used to a register just increasing or decreasing the checking account. QuickBooks will have a register for pretty much all the balance sheet accounts. So if we go into opening balance here and we say we want opening balance to go down by $79,896 and then just tell it what the other account is, QuickBooks will figure out then what those debits and credits are. So in order to do that, we're going to go down to accounting. We'll look at the accounting section here, and we're going to scroll down to the equity section. So it's in order by account type. We're looking, it's in assets, liabilities, equity. So here's the equity. Here's opening balance. So we want this opening balance. There's the balance we have in it. We want to get rid of that, put it into retained earnings. So we're going to select that item, view the register, and we could see the detail here. We could see our running balance. If I scroll to the right just a bit, there's our running balance, and we're ending at the $79,896. Scrolling back down and going back to the left a bit. There we have this. So we're going to add a new one. So it's going to be a journal entry format. If we select the formats, we don't have many. In essence, we're just entering a journal entry because typically we don't usually use the opening balance. So there's no normal form that would be created in order to deal with this area. So we're just going to say add journal entry. And we're going to put that journal entry at, I'm going to say the first date of the current year we're on, 01/01/21. January 1st, 2021, the first day of the year that we are currently going to be working on. And there's no payee memo. We could say adjust beginning balance. And we're not going to increase it, we're going to decrease it. So this is the key. There's no debits and credits here. We're going to say it needs to go down, $79,896. And then we're just going to put the other side somewhere. So I tabbed over to the other account, and that's going to be retained earnings. So we're looking for retained earnings. So we're going to select that one. So when we do this, this one should go down to zero, and then we'll go take a look at our report and see if the other account was retained earnings and if it does what we believe it should do. So let's go ahead and save that. So we're going to save that. And then if I scroll back over a little bit and scroll back up, it's down to zero. That's what we want. Now we're going to go to the reports. So we're going to go to reports once again. And we're looking for the trial balance, selecting the trial balance, and we're going to run the dates as of 01/01/21 to 01/01/21 and run that report. And there we have it. So we have the retained earnings here at $85,396. That looks like what we want. Opening balance is now zero. We're now ready to go forward. Notice what we don't have here are any temporary accounts, any income statement accounts, any revenue and expense accounts. That's because we need, those are going to be populated as we move forward into the current year. and enter normal day-to-day transactions. So let's go now, just go ahead and export this report. So we're going to go export and go to Excel. I'm going to export it as an Excel document. Here we have it opening up in Excel. Here is our report. So currently your default, okay, I'm going to say okay, enable, and it looks good just as is. So we're just going to say File, Save As, Browse to the location we want to put this. I'm going to put this into Excel Docs 6. I'm going to keep the name as is, so that'll be that. And there is our adjusted trial balance. Hello, in this presentation, we're going to set up and adjust new balances once an account has been set up for the first time within QuickBooks 2018. We will be continuing along with our comprehensive problem. If you've been working along with us, that is great. If you have not, that is okay too. You could take a look at this and see how these beginning balances would need to be adjusted for any company. We are working with the project of Get Great Guitars. If you've been working along and if you have access to the backup file and would like to just upload the backup file at this point in time to make sure that we're not missing anything, even if there was an error, even if we've been working along with us, then you can do so if you have access to that backup file. That would then be, once you have that, you'd go to the File tab, as we've seen before, and restore the backup file, open or restore. If you don't have that, that's fine. We can work through this and just see how these beginning balances would need to be adjusted. The story where we are at this point, we've set up a new company. Our new company is Get Great Guitars. We sell guitars. We've put in all the beginning balances into our worksheet using QuickBooks beginning balance option in prior videos. If you have questions on how to set up a new company and how to put the beginning balances in there, take a look at the prior videos. Now, the issue is that QuickBooks does a good job of us not having to use debits and credits, not needing to know too much about accounting in terms of debits and credits in order to set up the accounts. However, there is a bit of a cost to that, and there is something we do need to understand when we set up those beginning balances and a format to use that could maximize QuickBooks' ability to set up these accounts without those debits and credits. And that is that we put in all the accounts as of the first day before the new period that we were starting. And now that means that it's going to roll over and everything should be good as of the current period. So what we're going to do now is we're going to go to the trial balance, which is kind of like a list of accounts, and see those accounts in order, and then take a look at some balances we may want to adjust in order to correct some of the errors or some of the issues that may have happened by QuickBooks being able to quickly input this beginning data. So let's do this. We're going to go to, now if you don't have the View tab open, note that I like having the View tab open over here so that we can toggle from window to window. The only window open at this time, the Home tab. You can open this up by going to View and Open Windows, and that way we can see what we have open over here as we work through this. We're going to go to Reports to see what accounts we have. So I'm going to go to Reports here. We're going to go to the Accounting and Taxes. We're going to go to the trial balance and see what is in the trial balance. Now we entered all of our data, this being a project in the future because we have to work within this time period, remember. We're going to start the company and enter new data as of 2021, January 1st, 2021. We entered then the data as of the last date of the prior period so that as of the current period, that we're going to start entering data, we'll have all those beginning balances will have rolled forward correctly. So this is the date that we entered the data in as. I'm going to put 12/31/20, 12/31/20. We went through and entered all of our beginning balances as of this 12/31/20 balance. And therefore, QuickBooks put in all this information, and the beginning, this is what we actually put in, the checking account beginning balance, no two accounts, no debit and credit, just the beginning balance in the checking account. We entered all the customers and put in $20,500 from the 3 customers, I believe, here. And again, we didn't do that with a journal entry. We didn't need to know debits and credits. We entered the inventory account here, in terms of our products that we sell and that we have on hand as of the time we started this business. Again, we just put the beginning balances. We didn't put a journal entry in. We put the furniture and fixture. We put the vendors, meaning we listed the vendors that we have, in our case only one, and the fact that we owe that vendor $15,000. Again, no journal entry, just that amount. We had a credit card. We just put in the credit card balance. The loan, we just put in that balance. That's what we owe as of this point in time. And then we have this stuff, which if you just put in this balances, we would have no idea what this stuff is. This is the other side. This is the other side to the journal entries that QuickBooks created as we picked up all of these accounts. This then is what we really should adjust in order to make our financial statements correct. If you don't, it'll all be kind of in equity, and it won't be too bad. Your CPA or your accountant at the end of the year when you do taxes could probably pick that up and adjust it and know what is going on. But if we want to clean this up, clearly we should not have this uncategorized income and uncategorized expenses. Those are wrong. And this opening balance is not an account we typically have. That's basically a QuickBooks plug account. That's QuickBooks saying, I don't know where to put this, and we just put it in the opening balance. So that's what's happening here. Now these two we're not too concerned with, because note this is as of 12/31/20. That's the date before we're really going to start. We're not going to really start entering data until 21. And once we go to the next day, the current year that we're going to be working with, these two amounts will then roll over or close out to the equity account. And I'm going to show you that in a second. So although this is very strange, it's not going to bother us because we're not going to use QuickBooks prior to the year 21, although we entered all the data in as of 2020, because we did so in order just to get the balance sheet accounts to be correct, not the income statement accounts, because we're not worrying about them prior to that date. These are income statement accounts. They will then be temporary accounts. They will then close out. So I'll give an idea of what I'm talking about here. We're going to just change the date to the year that we will be working on. So this is going to be 01/01/21, and we'll make this 01/01/21. So January 1st, 2021. This is the first day of the year that we actually want to work on. And note what we have now, it disappeared. Those two balances disappeared. Those uncategorized income and uncategorized expenses, those temporary accounts, those income statement accounts, those income and expense accounts gone because they've been closed. Where did they go? How are we still working here? Why did QuickBooks need those balances? Well, it needed those to be in balance for our accounting system, and it closed them out to the owner's equity. That's where it's going to roll out the temporary accounts after each year, and it did that automatically. So that's great. We don't need to do anything to that because now we're fine as of the first date of the following year. However, we still have this opening balance equity, which we would like to get rid of here because this is not typically used. We really just want this owner's equity account. Now this is a sole proprietor, so we're going to assume we only have one owner in this case, and we only need to have one equity account then. That representing the amount, the book value of the company, the amount the company owes then back to the owner, or in other words, representing assets minus liabilities. So we really just want that one equity. If we had a partnership, then we'd have two equity accounts, and we'd have to worry about, we'd have capital accounts in essence, and we'd set up capital accounts and try to track who the net value, the net worth, the assets minus the liabilities is then owed to in terms of the two partners in accordance with the partnership agreement. If it was a corporation, then we'd have a retained earnings account that would be similar to this owner's equity account where we're going to roll over all the net income balances into. So in this case, all we want to do is move this amount here. Now, typically the best way to do this is kind of difficult to avoid journal entries in this case. So I'm going to go ahead and do a journal entry here, taking this $79,896, pulling it out of here, and I'm going to put it into this owner's equity account so that we no longer have this kind of weird account, this account we don't really want to see, this account that represents we kind of don't know what we're doing really, which is this opening balance equity. So we just want to get rid of that. We want to put it into the equity. So I'm going to do that with a journal entry. We'll see what a journal entry looks like here. It's the first time we have to actually use a journal entry in order to set things up to really get it proper. And note that this is a credit, so we need to make it go down. So I'm going to do the opposite. I'm going to debit that amount. So in order to get to the journal entries, we're going to go to the Company tab. We're going to go down to Make Journal Entries down here. Make Journal Entries, and here is our journal entry form. QuickBooks now automatically assigns numbers to journal entries. I'm going to say that's great. I'm going to say OK. The date of our journal entry is then going to be, I'm going to make it the last day again, just like we did with all the other ones, 12/31/2020. I'm going to keep their account number, their journal entry number. Note it made 2 journal entries prior to this as we entered our beginning balances. That's fine. We need to debit the opening balance equity to get that going down to 0. I forgot what the number is, but luckily we have our open balance windows open here, and we can toggle back and forth between the make journal entries and the trial balance. So we'll go back to the trial balance, and I'm seeing 79,896. So I'm going to go back to the make journal entries, and we're going to say 7989. Whoop. Oh, that's kind of funny. Now I hit the plus button. That's not good. 79896 tab. So let's check that one more time. 79896 trial balance. 79896. Okay. It's going to go into the owner equity. So I'm going to go to the second tab, owner equity. And if you start typing in there, of course, it'll fill in for you. There's going to be the owner equity. There is our debit and credit. Now, don't worry if you're thinking I'm going the wrong way. I don't know what debits and credits are. What if I do this backwards? Then we'll go back in. QuickBooks is very, very, very lenient in terms of adjusting journal entries after you do that, unlike other accounting software, which would want an audit trail and not let you delete basically anything. So we're going to say, could be good, but we won't get into that. But in any case, you could adjust this afterwards. So we're going to say save and close, and it's going to say, look, we're posting to retained earnings, which is unusual. Do you want us to do that? And we're going to say, yes, we do, because this is the setup process. Once that is done, then note that the owner capital goes down to 0, and the owner's equity then is increased to the 85,396. Now this looks more like what we would like typically to see. We just have that one equity account, that representing the assets minus the liabilities. If something happened, if there was an error or something went wrong in that process, if this balance does not go to 0, then we could just double click on this, change the date range to sometime in the past so that we can see the activity. There's the activity, and then we're looking for this journal entry. I believe this is the last one we did, bringing it to 0. This is a running balance of the activity. And so if we double click on that using the zoom, the auto zoom feature, and we get to this account. Now this is the ledger. For every account kind of has a ledger. If you want to see the actual journal entry, then, and you could work it through here. You can see the decrease here, and then it went to owner's equity. QuickBooks tries to do this so that we don't need to know kind of debits and credits, but the increase and decrease is almost as confusing as the debits and credits. So it might be just easier just to double click on the general journal, and then you'll see the journal entry. So here it is, and you can then change it again. And if you went the wrong way and you put a credit in the opening balance, then you can change it and go the other way. If you want to see the prior 3 journal entries, you can go backwards. We can go to the prior journal entry and see what's there. And it's saying no prior. Oh, here's 2. Furniture and fixture. When we entered the beginning balance in furniture and fixture, it entered a journal entry and labeled that. 1, when we entered the loan balances, was in prior videos, by the way, of course. It entered this data. So there's that. I'm going to go ahead and close this out, and I'm going to close this out, and I'm going to close this out, and you can see that it's closing back here. I'm going to stop this from happening by saying don't display this message in the future, and say that, and then we're back to the trial balance. So now all we have open is the home and the trial balance. All we have changed is closing out the excess equity accounts as of the first day of the current year we actually want operations in, and put that amount into the only equity account we want as a sole proprietor, that being the owner's equity account. Now we're going to go ahead and export this form, this to Excel as we've done in the past. It is possible to print this as a PDF or to print it, but we're going to export it to Excel to the same workbook that we have been working with in the past. If you have not been working with a workbook in the past or been following along, you can open a new Excel workbook. The export feature can be very useful. We are tracking the tabs as we go in the file that we're working on within the section. To export to Excel, we're going to go to the Excel tab up top. We're going to create a new worksheet, although it will be going to the same workbook. Clicking on this item. Next that will pop up, we have the create new worksheet, but we want it to be to an existing workbook. Then we're going to select the area that we have it going to. It's already going to the right area because we've done this before, but we want to browse. We want to find the Excel sheet that we want it to go to and click on that. And then it's going to open that, and we want to export to that Excel sheet then. Once we do that, it should open up that Excel sheet. It should export the data into a new tab within that Excel sheet. It takes a little bit of time, but then it pops up like this. And there we have it. So this is what we've done so far. Notice it put the new sheet kind of like right in the middle. I want to bring it over to the end, so I'm just going to click on it, left click and drag it to the end like that. Then we want to rename it. So I'm going to double click on it. And I'm going to call it trial balance adjusted, a DJ. And so it looks just like we had before. Last time we left off with a trial balance that was unadjusted. And now this tab we have a trial balance that we've adjusted, now making this basically 0. I'm going to make this a bit bigger. I'm going to hold down Control and scroll up. Or you can go over here and we're going to make it a little bit larger so we can see it there within Excel like so. And that is going to be that. That's our first basically journal entry that we were forced to use a journal. Now it is. Note that we're trying to do a lot of this stuff without having journal entries, without needing to know debits and credits. And QuickBooks puts together a lot of systems for us to do that, including us being able to enter these beginning balances without needing 2 accounts or debits and credits. It is also possible with the use of registers. It would have been possible for us to use registers to do what we did in this particular transaction. But in this case, I think the registers are as complex, if not more so, than using just journals. The registers, there's a register for each account. We saw them briefly, and they look kind of like the same thing as the check register. The thing confusing about registers is that when you're not talking about the checking account and you're talking about something like the opening balance equity register, it gets confusing on which, is it going up or down, and when you're closing it out to another equity account, including being, in this case, the owner's equity, it's just as difficult to know whether it's going up or down as it is to guess whether we're going to debit or credit an account. So in any case, this would be the last step you'd need to do. If you're working on setting up new accounts, this would be the last thing you'd need to do to really clean up that problem that will happen due to the fact that QuickBooks is trying to help you out by not making you correct journal entries. If you don't do this, then it will look kind of messy. It won't look as professional, but your accountant could probably figure it out at the end of the year. But it is something that could clean things up and make things look more professional as we go.